And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Tuesday already the month, the year, it's already under roll, going right past us. So here we are, Tuesday, already kind of heading into midweek, and markets are doing as expected. Of course, this is the first 5 days of January. Markets up yesterday, so that's good. Economic news continues to be very light right now, not a lot going on, but as we get into the next couple of weeks, we're going to start to see a lot of the December economic reports. Now, these are reports that we'll see which will wrap up the fourth quarter. Now, expectations for economic growth in the fourth quarter continue to be pretty high. The Atlanta Fed currently has the fourth quarter pegged around 7% annualized, so it's a fairly strong rate of growth. Blue chip analysts are closer to about 4%, but nonetheless, we're going to see a fairly strong print for the fourth quarter of the economy because that was kind of the wrap up of a lot of the fiscal stimulus that we had coming into the markets in 2021. Now, without the Build Back Better plan, the extension to child tax credits, all these other things that were in that plan, at the moment, those stimulus credits are now running out. So as we begin to look into the first quarter of 2022 and start talking about economic growth, that's going to start to show some signs of weakness as a lot of the buying pressure that was in the markets, of course, has now started to wane a bit. And this really has had a lot of effects on different areas of the economy, as we've been dealing with here for the last several months. The supply chain disruptions have been a big problem. Can't get the things that you want, right? You go to the store right now, there's empty shelves on some items. You just can't get what you want. And this is because we provided the people a lot of excess capital. They went out and bought a lot more stuff. And of course, with the economy kind of shut down because of the pandemic, we weren't producing as much. So that supply-demand imbalance led to shortages and higher prices. Auto sales, as a good example, used car sales. Used car sales right now are up about 38% from where they were pre-pandemic. So in other words, you're paying 38% more for a used car than you were pre-pandemic. Now, are used cars worth 38% more? No. It's just simply that there's no used cars available for sale. So if you want one, you're going to have to pay a premium for one. That's supply versus demand. That's where we are within the economic cycle right now. Now that will reverse. That won't stay this way forever. Used cars prices are now not permanently 38% higher than they were. Eventually that will reverse. Why will that reverse? Well, as the problem is now, people, because of their income, can't qualify to buy a used car at current prices. So there's going to be a reversion of demand from a couple of different sources. One will be lack of money coming in to spend, less liquidity as these programs and excess benefits run off. The second thing is people simply can't afford things, so they stop buying them. And then supply catches up with the demand. Then you get the reversal effect, which is where then demand begins to swamp your supply begins to swamp your demand, and now you get deflationary pressures. Now, this is going to be one of the challenges for the Fed over the course of the next year. They're talking about raising rates right now. There's a 76% probability the Fed will raise rates 4 times in 2022. They're expecting they're expecting this inflation that we're seeing in the economy to remain very persistent all year long. Now, that may be the case, that may not be the case, and we'll see. We're already starting to see some thawing of the supply chain disruptions. We're starting to see supply times start to come down. We're starting to see supplier delivery times start to revert back to more normal levels. So as that occurs, you're going to have a deflationary pressure in prices as supply catches up with waning demand. So this is going to be an interesting year as we move forward because there's so many unknowns about the things that we're going to be dealing with. And this is kind of the topic of our Technically Speaking report today on the website, talking about the risk to 2022. and looking ahead for that, because there's a lot of things that have been tailwinds for us for the last couple of years in particular that are now going to reverse. Keep a watch on supply chains. That's really the key to a lot of this stuff, and that we're going to be talking about. And this is going to be a kind of a consistent topic probably for most of this year, is talking about the reversal of inflation to deflation, slower economic growth, and a reversal in earnings expectations as margins begin to get compressed because of lack of demand, as well as lack of liquidity in markets as a lot of these stimulus benefits fade away. Now, this is all predicated on the idea that we're not going to have a lot more benefits coming in. Of course, if the economy slips into a recession, or worse, we have another variant and somebody does decide to shut down the economy, and we have another big surge of stimulus, that's going to change the dynamic of the conversation. But right now, if we expect everything to kind of remain status quo, a lot of the tailwinds that we saw over the last 2 years will now begin to fade as we get into 2022. So just keep a watch on that. That's something that we're going to talk about a lot this year as we go forward. The market yesterday rallied back to basically pushing back up into its very overbought condition. Again, we're still in a buy signal, nothing to worry about here, no reason to really make a change. We're looking for an opportunity to launch a new portfolio here in the next month or two. So what we need is for this overbought condition to reverse, a normal kind of correctionary period in the markets, maybe sometime in February or March. We get that correction, we'll launch a new momentum-based portfolio that we're looking at. So again, just kind of looking for the right opportunity to put that money to work. But again, just keep a watch here. Markets are doing well. Apple yesterday, the first company ever in history to hit a $3 trillion market cap. Now, that's pretty incredible. Considering that Apple was just a $1 trillion company as we got into 2022. So, in 2020, and as the markets were kind of, coming off that March 2020 low, we saw that Apple expanded their price. Again, we've talked about this over the course of the last 2 years, that the market has consistently been hiding cash in stocks like Apple, Microsoft, Amazon, Google. The top 10 stocks have made up about 65% of the overall move in the market. So it's been a place where capital's been hiding. And the question really is that $3 trillion market cap and doubling that valuation in just 2 years, can earnings growth catch up to that valuation? Of course, that's going to be one of the key issues here. If you take a look at earnings per share, if you take a look at growth per share, etc., a lot of that valuation that's been built into the market has been supported by massive rounds of share buybacks. Apple's been a very prolific buyer of their own shares. Of course, that benefits insiders and also suppresses the valuation. So again, while their valuation may not seem as expensive as a $3 trillion market cap, a lot of that has been an effect of these massive share buybacks that Apple's been involved in. So again, just kind of a symbol of where we are in the economy. Tripling your valuation in 2 years has really been coincident with also the surge of liquidity, both on a global basis from central banks as well as investors over the last 2 years, and particularly chasing these large cap stocks. Well, when we come back from the break, we're going to get into our investor resolutions for 2022. This is something that we do on an annual basis, but it's always a good reminder about the things we should be doing and the processes and resolutions that we should be following to manage our money better. We'll talk about that after the break. I'm Carlos Lance Roberts for The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Don't let 2022 be a repeat of the past year. Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid, tax advantages we see, and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. realinvestmentadvice.com. Click on the insurance tab.
What worries you about your money? Enhance your financial success with RIA Advisor's free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. It's 6:17 as we get this morning underway. A little bit of history to get into before we talk about resolutions. Back in my early 20s, I used to build health and fitness facilities. And so these were kind of big, sprawling, 15, 20,000 square foot facilities with, all the equipment and everything. And we catered to corporate clients as well as individuals. And, that was an interesting business. And yes, just hold on with me for a second. There actually is a relationship between building gyms and investor resolutions. But it's an interesting business because at any given time, I could only have so many people inside of a facility, right? Fire codes, but there was only so much equipment inside the gym. So, I couldn't have 5,000 members in the gym all at the same time. Now, I never had a cap on the number of memberships I could sell, right? So if the capacity of my gym is only X, then there should be only X number of memberships to sell. Based on the number of hours that we're open, there should be a maximum capacity, but it doesn't work that way. The reason that gyms can sell indefinitely memberships is because memberships to gyms are a very lucrative item. Have you ever wondered why you can't go to a gym and just pay $5 to work out? Because it'll mess up their metrics. And what I mean by that is that what gyms depend on is the recurring billing on your credit card or your bank statement. What do gyms know that you don't? Well, actually, you do know this, but gyms know it better than anybody else. And that is that you're going to sign up, you're going to come to the gym for a week, and then you're going to quit coming. And I'm going to keep billing you. And you're going to forget about that bill hitting your credit card or your bank statement for a couple of months because you have every intent in the world. Yeah, you were going for a couple of weeks. It's New Year's, right? So every New Year's, we all make the resolution that, well, we're going to get in shape and we're going to go to the gym. We're going to eat better. We're going to do all these things, right? So we start out, and gyms are terrible in the first month of the year. They're packed. They're crowded. It's just everybody's doing their New Year's thing. By February, there's nobody at the gym. And I keep billing you. And I bill you in March. And you get the bill and you see it. It goes, I'm going to, Monday I'm going back to the gym. And you don't. and I bill you again the next month. And next month you say, you know what, I'm going to get back to, I really need to go to work. And see, this becomes a guilt complex with you. You see that charge on your billing statement, and you know you should be going to the gym and doing better for your health. And so now it's become a penalty, right? And you're going to leave that charge there to punish yourself because you're not doing what you know you should be doing, which is going to the gym. And people will let that charge sit on their bank statement for months, even years, before they eventually finally give up and cancel the membership. That's why the gym business is very lucrative. Love that business. Just bill people and give them no service whatsoever. It's awesome. Right? There's no other business in the world that you can get away with that in, right? Every other business like ours, now is all service-based. We've got to give our clients service 24 hours a day, 7 days a week. That's what we provide. You need us, we're here. The gym business isn't that way. It's great. Now, what does that have to do with resolutions? The point about resolutions is this, is that we all make resolutions at the beginning of the year and we say, hey, we're going to do all these great things. We're going to go to the gym. We're going to eat better. We're going to take better care of ourselves. We're going to, go to church more often. Whatever it is, right? We all make our resolutions. Unfortunately, we don't do a very good job of adhering to them. We may do it for a little while, but we do a very poor job overall, I'm not saying everybody, about sticking to them. And there's some reasons for that, right? In order for a resolution to become attainable, it has to become a habit. And to make it a habit, it has to be something that can fit within your lifestyle, something that you do almost automatically. It's not something that you have to think about. It's not something that you've got to go make special provisions for. It's just got to be a function of something, right? Brent will tell you, every day I do the show, I get off the show, I do some work, but at 8 o'clock, I head down to the gym and work out every day. It's my routine, right? And don't mess with my routine. Do not call me to schedule a meeting at 8 o'clock in the morning, right? Don't mess with my routine. I'm available for you the other 23 hours of the day, but not from 8 to 9 o'clock because it's just habit. My diet is a function of habit. How I eat, what I prepare, etc. is all part of a habit. And that's the only, and look, and that's just me, but that's the only way that I can make it happen. If I don't have that habit, I won't stick to the resolution, right? So this is the function of when it comes down to investing, is that your investing resolutions also have to become habit in how you manage your money. So in today's daily commentary, if you go to our website, realinvestmentadvice.com, click on our daily commentary link at the top of the page, subscribe to that. It's free. Just stick in your email address. We'll send you our daily market commentary every morning before the bell opens. But we actually listed our 2022 investor resolutions. And these are simple, right? Do more of what's working, less of what isn't. The one, it sounds easy, but it's the one thing that we don't do nearly enough of. We tend to stick with things that aren't working, continue to do things that don't work well, and ignore the things that are working well. Do the things that work well better, your overall portfolio will be better. Remember that the trend of the market's your friend. It's something that we want to fight. It's a natural habit to want to fight the trend of the market, but don't. Importantly, be either bullish or bearish. You can make money being bullish, you can make money being bearish, but eventually if you're piggish, you're going to get slaughtered. And this is the important facet of investing over time, is to not get greedy. Remember, it's okay to pay taxes. I've seen too many people avoid selling something because they don't want to pay taxes and they wind up turning a winner into a loser. Maximize profits by staging buys. In other words, you don't have to buy everything all at once. You can nibble into something over time, let it work for you, keep adding up into the position. Look for damaged opportunities, not damaged investments. Just because something's gone down a lot in price doesn't mean it's a good buy. There are companies that get hit for an unexpected reason, a very short-term dynamic to their business, whatever it is. That's a damaged opportunity, and that's probably worth buying. We saw that happen a couple of times last year with Abbott, as an example, in our portfolio. Stock had big fall-offs because of very short-term blips on news items. Didn't change their business model at all. Those were great buying opportunities. Diversify your portfolio to control risk, but that does not mean buy stuff that is just underperforming. Diversification is a function of diversifying between winners, not diversifying into losers. That goes a long way into the conversation about rebalancing. Rebalancing is a poor strategy over time because you wind up selling your winners to buy losers. Control risk is important. One thing that investors don't do well, we touched on this yesterday, whether we drive or whether we jump out of an airplane or whatever it is, we always have safety precautions. Playing football, we wear pads, right? So, no matter playing baseball, we wear a helmet when we're batting. The reason is because there's risk of injury. And so we take precautions to prevent injury. When it comes to investing, we don't do that. But we should. So always have a stop loss when you buy something. Have measures of risk avoidance, control the risk in your portfolios, and you're going to win long term. Do your homework is always important. The one thing we don't do nearly enough is do research. We just buy stuff because we hear about it on CNBC. Learn to do some research. At least understand the basic dynamics of what you're buying into, and more importantly, understand what the company does. I've seen a lot of people buy companies, and I go, well, what do they do? And they're like, I don't know. Stock price is going up, though. Understand what the company does. Understand what you're buying. Don't allow panic to influence your decisions. The one things that we do poorly is that when things start going against us, we tend to panic and do things in a hurry without really thinking things through. Sometimes the best thing to do is just to turn off the computer for a few minutes, go sit down, think about what's going on, and try to make a reasonable, rational decision based on fundamentals, doing some homework. But don't let panic, don't let an emotional driven decision handle your trade, because ultimately you'll wind up making a bad trade more often than not. Expect to be wrong. This is one thing that we do poorly as investors, is that when we're wrong, we fail to admit we're wrong, and because we don't want to admit that we were wrong, right? I mean, that's just kind of human nature. Is like, I'm not wrong. This stock's going to ultimately be a great company. When you're wrong, you're wrong. And everybody's going to be wrong eventually in investing. And so this goes to the very heart of, the rule of cut losers short, let your winners run. When you're wrong, you're wrong. Doesn't mean you can't ever buy that stock again. One of the things I've always found interesting is people will sell a stock and then they're convinced that they've now that they've been, kind of pushed into this corner where they are never allowed to buy that stock back. That's not the case. If you buy something wrong and it goes down in price, sell it. And then once it settles down, forms a new base, buy it back. Just because you bought it wrong doesn't mean you can't buy it again. Be flexible in your strategy. And most importantly, turn off the television. Not the radio show, just the television. Seriously, though, watching the media is a terrible way to manage your portfolio, and it's one of the things that's going to drive you into making emotional decisions. When I'm working during the day, I don't have the television on. We have CNBC on in the studio right now, only so I can kind of see what's happening with the market futures. But once I get off the show, no more of that, because I want to focus on doing my homework, making the right decisions, managing my risk. That's what matters in portfolio management, not what you hear on the television. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Don't let 2022 be a repeat of the past year. Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid, tax advantages we see, and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If you have money, you can get access to debt, right? People loan you money if you have money. If you don't need money, the banks are happy to lend you money. And if you owe the bank a lot of money, the banks are happy to loan you money because they don't want you to default. They're just going to lend you more money to try to hope. And it's like if you owe the bank $100,000, it's your problem. If you owe the bank $1 million, it's the bank's problem.
The Real Investment Show podcast. Same show, your schedule at realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com with Ratliff and Rosso. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, just kind of going through our investor resolutions. The key to, again, any type of resolution, whether it's an investor resolution or whether it's just a resolution in life, right? I mean, every year we all set out with our resolutions. We're going to get, like I said, get in shape, eat better, whatever it is. We're going to be healthier this year. It's a function of making habits. And, it's easy to tell you what you should do in terms of managing your money, but the reality is that you've got to form habits. And that takes time and it takes patience. And, in a market that seemingly just kind of goes up in value every day, it's hard to form good habits. And this is really the challenge that a lot of investors deal with. But Lance, if I employ risk management, that means I may not make as much as the market. That's true, right? That's the point of risk management. Is to control the risk of losing a lot of money. And in order to do that, you've got to potentially give up some of the upside. Not necessarily all of it, but some of it. But this is the thing that, when you talk about the media, right, it's the one thing they tell you that you shouldn't do. Every year there's a plethora of articles written because the S&P comes out with what they call their SPIVA report every year. And the SPIVA report tells you how many active fund managers outperform the index in a given year. And the purpose of that is to get you to buy a passive index fund. And the reason that that the analysis is heavily flawed is because of the way it's calculated. And this is the same thing that you see in mutual fund tear sheets, etc. Like over the last 1, 3, 5, and 10 years, the fund has done this. Well, what that assumes is that you bought the fund in year 1 and have held it for 3, 5, and 10 years. If you bought it anywhere in between that period, your returns were vastly different. So that analysis is really very poor in terms of picking your investments. But in a roaring bull market, and especially one that's been driven by so much liquidity as we've seen over the last 2 years in particular, between the federal government and the Federal Reserve, it's easy to form very bad habits. I can take on a lot of risk. I don't have to really worry about downside too much, and markets just kind of keep going up. And so it's easy to start taking on a lot of risk in terms of buying companies that are, grossly overvalued, have no fundamental value, whatever it is. And the reason that happens, of course, is because of human psychology, right? It's the greed factor. And so it's hard to develop good resolutions. And this is the thing. It's hard to develop good resolutions because good resolutions, in terms of managing your portfolio, require you to sacrifice, almost in all cases. Think about it this way. I want to get in better shape. I'm overweight. I'm unhealthy. I have high cholesterol. I have all these things. Okay, well, how did you get there? Well, because I was eating out every day, and I was having steaks and hamburgers and pizza and not exercising and watching a lot of television, whatever it is, right? But it was easy to get to being very overweight and out of shape and unhealthy because we didn't have to do anything. All we had to do was just do all the things that we like, right? I like eating hamburgers and steak and pizza. I like that. It's fun. It tastes great. Makes me feel good. It's not good for me. So getting into bad habits is easy because we get to do all the things that we like to get into bad habits. The problem is getting into good habits requires sacrifice. And learning to live without things and learning to do things differently requires work. And we don't like that. And that's why resolutions are very hard to stick to. But if we stick to them and we get into a good place, then it becomes a function of habit and it's easy. It's still not as fun as eating pizza and hamburgers, but it's livable and doable, and I can do it as a function of habit. And this is the problem with forming good resolutions. It requires sacrifice. We've got to be willing to do that. We got to do the work. We didn't get overweight and out of shape and unhealthy overnight. We're not going to get back into shape and healthy overnight either. It's going to take just as long to get back, and it requires a lot of work. And when it comes to investing, it's the same structure. It requires work to develop good solutions and good habits. But, and again, we're going to deviate from those habits, right? It doesn't matter how good of a discipline that we have. We're eventually going to make a bad decision. We're eventually going to do the wrong thing. We're eventually going to slip back into an old way of doing something because of what's happening in the markets. And that's okay. Just you've got to get back onto track afterwards. We've talked about our good friend Keith Klein here on the show a few times, who always had a great saying. He's like, build better bad habits. And what he means by that is that you can't change everything overnight. But if you have a bad habit, right? So for instance, your habit is every day you have, I actually had a friend of mine that I used to work with many, many years ago. I owned a manufacturing company. And in that business, every day, one of the guys I worked with would go out and he would buy a Happy Meal, McDonald's Happy Meal for lunch. That was his thing every day. And he'd take the toy and then he would drive by the construction site. And if there were any kids around or whatever, he'd give the toys to the kids. That was his thing every day. Well, as you can imagine, he wasn't in the best of shape and he wasn't that healthy. But you can make a better bad habit. That's his bad habit. Well, what could he do differently? Well, order the McDonald's Happy Meal without cheese, right? Start building a better bad habit. And that's the same thing when it comes to investing, is that you have bad habits when you invest. Try to start building better bad habits. Try to do one thing better each time that you trade or invest money so that you have a better outcome in the future. You know, if you buy a stock, start adding stop losses to your portfolio. Start developing better risk management controls. And once you start building a small, better, bad habit, then it's easier to build on that bad habit, right? So I do one thing better on that bad habit, so now it's not as fattening or as bad for me as it was. And then I add another thing. So now I order the Happy Meal with no cheese and no mayo, right? So now I've got a dry hamburger with pickles and meat. But it's a better bad habit. Eventually, I've got to wean myself off of the bad habit entirely. But I get there in time rather than trying to go cold turkey. And this is the problem with most investors. They try to do these things all at once, and then the market shifts on them. And they go, well, if I hadn't been doing that, I would have made more money. Yeah. And so they immediately go back to what they were doing before. Trying to go cold turkey on anything is very difficult. So try to do things very slowly. Take the resolutions, break them down, implement them one at a time. You know, develop your own resolutions. These are just mine. You know, if you go to our daily commentary, if you didn't hear earlier, so we're going through the resolutions in the last segment. They're on our website today under our daily market commentary. And I've also got it coming out in a more explanatory article on Friday as well. So if you go by our website, you'll be able to pick up the article on Friday. But, you know, just make small steps, build better bad habits in your investing, and you'll have a better outcome longer term. And this is going to, and again, this is going to be, you know, much more valuable as we get into this year. As we talked about earlier, you know, this year is going to be challenging. We've got a lot of headwinds that are about now becoming tailwinds. Our article on our website today is talking about the risk of 2022. You know, slower economic growth, inflationary pressures are going to remain, you know, more persistent early on, but then begin to fade later this year. Rising wage and input costs are going to pressure profit margins. Valuations are elevated. You know, just, you know, a lot of the things that we had that were supporting the market over the last year are going to be changing. And again, so, you know, the things that were working last year may not work this year. Maybe this is the year that value actually starts to outperform growth for a change. We haven't seen that in a while. Value's really underperformed last year by a large margin. Growth has been kind of the consistent go-to. And this is why we see companies like Apple, Microsoft, Amazon, Google. The top 10 stocks of the S&P have made up the vast majority of the gains in the S&P over the last year. And that kind of very narrow market breadth is something that is not healthy for the markets longer term, and is something that we've only seen really near peaks of major bull markets. Now, I'm not saying that the market's about to crash and have a big bear market. I'm just saying the behavior is something that we haven't seen since 1999. Does that mean we're in a bubble? Who knows? There's lots of things that make up a bubble. Psychology is one of them. When we come back from the break, we'll wrap up the show. Get by the website. Those resolutions are in our daily market commentary today. Just click on that link. Subscribe while you're there. We'll deliver the daily market commentary to you every morning at 7:30 a.m. sharp. Be in your email inbox. Our comments and thoughts about the markets for the day. All on the website. Absolutely free, of course. realinvestmentadvice.com. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Don't let 2022 be a repeat of the past year. Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid, tax advantages we see, and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. realinvestmentadvice.com. Click on the insurance tab.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Get ready to wrap it up as we get through this Tuesday. Get ready for the markets to open this morning. Futures are slightly higher. Dow's up about 100 points following yesterday's rally. Market, as we talked about this morning at the open, is, pretty overbought here. We're pushing about 2 standard deviations above the 50-day moving average. And I know that's a lot of mumbo jumbo and, technical stuff. But all that means is, prices can only move so far in one direction. So it's kind of like stretching a rubber band. I use this analogy a lot. And, the markets right now, you kind of stretch them as far as you can in one direction. And typically when we see this kind of this combined extension and overbought condition, you're going to get a correction of some sort, 2-3%, probably a pullback to the 50-day moving average. That was really the action all of last year. We would have this rally, the market would kind of flatten out, stumble around a little bit, correct back to the 50-day, rally again. So again, in the next 2 weeks, very likely the market can kind of hang around where it is, and then as we approach options expiration kind of later this month, might see a correction back to the 50-day moving average, and we'll kind of step and repeat all over again. So be a better opportunity potentially to allocate some capital to the markets, wait for a little bit of a pullback or correction. A lot of the high flyers from last year early, particularly the stocks that are owned by like ARK Investments have really tumbled lately. The Pinterest, the Etsy's, the kind of the online disruptor stocks have tumbled a lot. So the question is, are those going to come back, right? Are they just kind of consolidating gains and going to have a corrective action back to the upside? Maybe. We're not seeing signs of that just yet. Yesterday's market action was fairly weak. It was primarily driven by Apple, Microsoft, Amazon, Apple, Google, and Tesla was primarily the winners yesterday. Energy stocks, which make up a very small percentage of the S&P, did well, and financials did well. Outside of that, there was kind of a lot of red within the rest of the market. So again, kind of that same action that we've seen here over the last several months is this market kind of rallying on very weak breadth. If you take a look at advanced decline lines, they're not improving much. 50-day stocks above the 50-day, 200-day are still below previous highs, not really consistent with the market at all-time highs. But, again, just that's been the action of the market for a while now. It's been fairly narrow. So, again, that may change here. We'll see. Cryptocurrencies have pulled back from recent highs. They're not, haven't been performing that great as of late. Certainly not keeping up with the speculative action of the markets. Certainly not keeping up with inflation. One of the interesting stories early this year is that Bitcoin was going to be the replacement for gold as an inflation hedge. That really hasn't worked out very well. But again, that asset class is now becoming worth watching because it's getting a more dominant position within the overall markets and overall analysis. So as a measure of risk appetite, it's definitely worth watching. But again, these are kind of the things that, we are watching, as we get kind of into this new year. And again, right now, it's hard to take much of what's happening in the markets with any seriousness because it's just a lot of positioning. People that, and mutual fund managers, hedge fund managers, portfolio managers, they need to have certain positions on their books so that when they issue out reports and they want to keep up with the market, I better own the stocks that are pacing the markets. Well, if I want to keep up with the S&P, how do I keep up with the S&P or potentially even beat it? By the top 10 stocks of the S&P. What rallied yesterday? Apple, Nvidia, Tesla, top 10 stocks of the S&P. So if I want to pace the S&P and I want to be in the game as a portfolio manager, as a mutual fund manager, I need to own those top 10 stocks or some form of them. I just have a personal bias against owning Facebook, even though it's going up. I just can't do it. Can't bring myself to do it. Not gonna do it. But I can make it up. I can make it up in other holdings. But these are the decisions that you have to make as a investment person, right? And if you're investing your own money and doing it your own way, that's great. That's why we built SimpleVisor.com, which gives you analysis at your fingertips. You can quickly scan for the top 10 stocks that have the most momentum, the most relative strength. Those are all kind of posted for you every day. So the whole purpose of that site is to give you access to the same research that we use in building our portfolios. And you can track our portfolios there as well if you want. SimpleVisor.com. It's easy. But these are all things that as we talk about a new year, and thinking about what's ahead, we're going to have to start making these broader decisions. And some of this is guesswork. Byron Wien over at BlackRock, he traditionally comes out with his top 10 kind of picks or his forecast for the year. And, this is something that everybody does, right? We have, and I'm actually just trying to get my mouse to work over here for some reason. I've lost control of my mouse. There it is. The issue ultimately is that we see a lot of people that make predictions, but again, these are predictions that, ultimately are things that at the end of the day are just guesses. And we really have no idea, on these guesses about how to do it. But, for instance, the combination, these are some of his predictions for 2022. The combination of strong earnings clashes with rising interest rates, resulting in the S&P 500 making no progress this year. So in other words, the year ends about where it starts. That's kind of unusual considering that the most of Wall Street is predicting S&P 5,000 to S&P 5,500 by the end of the year. While prices of some commodities decline, wages and rents continue to rise, and the CPI and other widely followed measures of inflation increased by 4.5% for the year. Persistent inflation. That's going to be a problem, but that goes back to the profit margin story. If you take a look at the composition of earnings estimates, a large chunk of earnings growth this year is expected to come from expanded profit margins. So if you have rising persistent inflation, that is going to weigh on profit margins because it's going to reduce that, and that's going to reduce earnings growth. And if earnings growth slows, that's going to make valuations very hard to sustain at these current levels. The bond market begins to respond to rising inflation and tapering by the Federal Reserve. 10-year Treasury yields rise to 2.75%. Now, having said that, he predicted that Treasury yields would rise to 2% last year and never even got close. So he'll probably be wrong on the bond front. In spite of the Omicron variant, I misread that. In spite of the Omicron variant, group meetings and convention gatherings return to pre-pandemic levels by the end of the year. That would be a good thing, by the way. If we want the economy to get back on track, we need to get back to doing what we do normally, right? We need to go back to the office. We need to go back to work. We need to go back to doing things and, treat the various variants of the virus like we do the various variants of the flu, and move on with life. That's the only way that the economy is going to get back to normal. Chinese policymakers respond to recent turmoil in the country's property markets by curbing speculative investment in housing. Evergrande just had another blow. They built a big resort that had to get torn down because it was built improperly. So they just took another big hit to the property markets. Now, this is something that we talked about on the show probably a decade ago, when China was building these entire cities to replicate, New York and Los Angeles and China, and they were literally building housing complexes in 2 or 3 days, right? And they had whole cities that were built that were empty. Nobody was even living there. There's just massive development of housing. We said this is eventually going to come to ruin, and that's exactly what's happening now, and everybody's acting surprised. It's like, surprise! No, not really. It's like Gomer Pyle. Surprise, surprise, surprise. Only old people get that joke. Anyway, the price of gold rallies by 20% to a record high. Don't doubt that. We'll see. Gold did not have that good of a performance last year. Certainly did not pace inflation. We'll see if that analysis changes this year. Major oil-producing countries conclude that high oil prices are speeding up the implementation of alternative energy programs and allow U.S. shale producers to become profitable again. These countries can increase production enough to meet demand. The price of West Texas crude rises above $100 a barrel. This is the whole conundrum, I guess, or funny thing about alternative energy is that it actually spokes more use of energy from oil production. Go figure it out. Nuclear alternative for power generation actually enters the arena. Actually, that's actually occurring right now. The EU, yesterday, we saw shares of uranium stocks go up sharply as the EU is starting to actually consider nuclear power plants because their alternative sources of energy are not keeping up with power needs. Wind and solar is great until you actually need power. ESG evolves beyond corporate policy statements, and government agencies develop and enforce new regulatory environments. And in a setback to the green energy program, this is actually one that will probably be true. In a setback to the green energy program, the U.S. finds it cannot buy enough lithium batteries to power the electric vehicles planned, and China controls all the lithium. So there you have the upcoming basis of World War III. Oh, the last part was mine. Anyway, have a great day. We'll be back tomorrow for Wednesday's edition. Danny Ratliff will join me. We'll get into some of the other topics that involve you and your money. Of course, as always, stick around. Chris Salcedo coming right up here after me. And have a great day. Get by the website, realinvestmentadvice.com. Send us your questions, comments, emails. Let us know what we can do for you. Also, get our daily commentary with our investor resolutions for the year. That's on the website right now. It's absolutely free, of course. realinvestmentadvice.com. We'll see you back here tomorrow.
If I had a little money, it's a rich man's world. It's a rich man's world.